Good morning, ladies and gentlemen, and welcome to the EENERGY Group PLC investor presentation. Throughout this recorded presentation, investors will be in listen-only mode. Questions are encouraged. They can be submitted at any time via the Q&A tab that's just situated on the right-hand corner of your screen. Please just simply type in your questions and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, the company can review all questions submitted today and will publish those responses where it's appropriate to do so on the Investor Meet Company platform. Before we begin, we would just like to submit the following poll, which will just appear on your screens now. And I would now like to hand you over to the executive management team from EENERGY PLC. Harvey, good morning, sir.
Good morning and welcome everybody, and thank you for attending this morning's presentation. Before we start, I'd just like to say that we've taken on board a lot of investor comments and concerns, and I hope that today's meeting is going to provide you with an update on what we feel is a really important inflection point for the company. So look, once again, on behalf of the board, we do apologise for the lateness of the 24 accounts, but we hope that you'll agree that the publication of the half-year results yesterday within 3 weeks of period end is a testament to the new team and the processes in the finance function at EENERGY under John's leadership. So let's now move on to the trading update, so I can give you a full update. I think there are a few key points that I'd like to first start on, and that is to emphasise that this is our fifth year of consistent revenue growth. Revenue year on year for the first half is now up 67% to 10.1 million. Adjusted EBITDA has improved by 2.5 million to generate 500,000 of profit. But more importantly, the half-year period is cash positive, and this is a very important, crucial inflection point for our organic growth and the efficiencies that we're delivering through to the business. It's the strongest sales pipeline in the period we've ever built. So I think that demonstrates quite how much investment is now coming through from all of the hard work we put into the back end of last year. The Redaptive partnership is going from strength to strength. The 100 million facility that we've secured has already been used. We've deployed 7.6 million very quickly from the get-go, and we've been named as a dedicated UK delivery partner for the Redaptive strategy for the UK region, and we can start to see really strong pipeline opportunities coming through from Redaptive, and we continue to work with them on a daily basis to explore new opportunities, both that we generate for funding and that they generate for us to do delivery. Solar Life is now providing recurring revenue streams. We believe that the O&M market, that's operations and maintenance for solar, is a very attractive, very fragmented and very profitable market. We've now got 78 systems under contract, worth in total just under 1 million, that's unlocking recurring revenues of circa 90,000 a year. We hope to significantly improve that over the next year, and we think that's going to give sustainable and long-term recurring revenue streams that will be attractive to investors. As you know, channel strategy for growth has been a key pivot for us as we complement our direct sales strategy. We're now on 5 active frameworks, and we've had lots of early wins across NHS trusts and multi-academy trusts. This is a significant change in our business model. That's not to say that we are doing anything different in direct sales. This is completely complementary. And as leader in education, we're starting to expand into the different silos of education, in particular higher education and universities, and these frameworks are starting to become extremely lucrative for us, and our pipeline in the future has seen significant growth in this area. In the period on our pipeline, we've generated a record 83 million in the period, and 38 million of that is at the investment grade development process. That means that we've gone past the point of commercial qualification, and we've started to invest in the project, either at assessment or investing further down the investment pipeline phase, where we're talking about D&O applications post commercial signing of terms. And this is evident now, having signed a record 15 million of heads of terms in period that will be on plan for H2. And I'll talk a little bit further about that shortly. But I'm going to hand over to John now to talk about the results, and then I'll talk a little bit more about the outlook.
Good morning, everybody. let me start by saying that we were pleased with the first half results, but we're not complacent. This is just the start of further improvements to come through. It's clear that the stringent control environment we've introduced are driving material improvements in the results. The headline numbers show revenue at 10.1 million, up 67% on the first half of last year of 6. Adjusted EBITDA of 500,000 is 2.5 million ahead of the 500,000 adjusted loss we reported in the first half of last year. And most pleasingly of all for me is we've got positive net cash flow of 0.8 million in the first half of the year. Adjusted EBITDA and cash flow are now tracking one another. So as we see profit coming through, we see cash coming through. So we've clearly now aligned and adjusted for and matched the cash and profit coming through from trading activities, which is really important. Cash at the 30th of June was 3.1 million compared to 2.3 million at the end of last year. So significant improvement in the first half of this year, we expect significant further improvement in the second half of this year. So as Harvey said, the interim results have been produced in 3 weeks. Last year, it took us 3 months to produce the interims. We've combined the trading update and interim results into one announcement, which, thank you very much to my team. Their professionalism and hard work to get us to this point is demonstrable of the improvements we've made in our financial reporting, and the stringent financial controls we've introduced are really helping drive financial improvement across the business. And we're seeing that in all of our key financial metrics. Everything is moving in the right direction. We're not complacent. This is just the start. I can also see, and we're sort of finance are helping facilitate this, we're working much more closely across the business as one team, which is really making us joined up and much more efficient. As I said, we expect to be cash positive in the second half of 2025, and that will actually make us cash positive over the year as a whole, which is really, really pleasing. Cash remains our principal KPI. Looking at some of the other financial metrics, they also all demonstrate solid progress. Pleasingly, gross margin improved to 41.6%. This compares to the first half of last year at 19.2% and financial year 2025 at 34.6%. These are very material, significant improvements, and we've done this through clear messaging with vendors with no PO, no go. If you don't have a purchase order, we're not going to be paying for your extra project costs. Everything needs to be pre-approved via a purchase order. It's giving us really tight control over all projects that are in flight. And so the margin leakage, which we were experiencing historically, has been significantly tightened up. I'm also approving all quotations that go out to customers. So we get a chance to check and review all the costings prior to submission of the quote to the customer to make sure we've got everything included, so that when we give a quote to the customer, they know and we know it's a fixed price job, and we can be comfortable and confident that the costings we've included are accurate. All of this is coming through in higher gross margins, which is really pleasing. And the sales team have done a great job selling new business into the market at margins which are showing margin enhancement for us. So better sales activity in conjunction with tighter financial controls and a favourable sales mix, because there were a lot more of LED sales in the first half of this year, has helped drive up the gross margin in the first half. So very pleased with that. Adjusted EBITDA pre-central costs increased to 1.4 million. This is the EBITDA that we generate from the operating business pre-central costs. That's equivalent to 14.4% of revenue. I think this has got scope to significantly increase over time as we scale up the business. Effectively, we've improved our operational gearing because we've reduced the total operating costs of the LED and solar business by 10% of revenue, 10% to now 20%, 27% of revenue, which is helpful because it means that more of the incremental revenue drops down to the bottom line in terms of profit and cash flow critically. We made some further reductions in the cost base around the half year, with the benefit to flow through in Q3 and Q4, which will be helpful. And Harvey and I have looked at the cost base quite clearly, and we're confident that where we are today, we can support a significant increase in the revenue from the current cost base, which is really good news. Central costs were held at 0.9 million, same as they were last year. Not much to say there. I just wanted to touch on this. It's quite important. There's only one adjusting exceptional item in the first half of this year. And that one adjusting item is a non-cash share-based payments charge of £0.4 million. And the restructuring costs that we have incurred, which are circa 0.2 million, have all been included within the operating cost line. As I said back in the January trading update, we would not have any other sort of restructuring and exceptional costs coming through the P&L this year, which obviously has a tendency, given that it's bad news, to sort of to push it below the line. We've not done that. We've actually taken that as part of the ongoing business. So our 0.5 million would have actually been 0.7 million had we not done that. So some of the restructuring costs that we will incur, it's quite normal for a business to do that, is now part of the normal operating costs, unless they were very substantial. Clearly, post the sale of the energy management division, there was a substantial amount of restructuring work that had to take place, and obviously the cost was separately disclosed. Last year, the exceptional charge was 2.3 million, which obviously included the 2 million restructuring cost post the sale of the energy management business. Total charge was 2.3, of which 2 was restructuring and 300,000 was share-based payments. So just to summarize, cash generation remains principal focus. We're all aligned across the business. People know it's important to us. We're totally focused on it. And the adaptive funding deals are helping to improve our cash flow by advancing cash to us more quickly than other funders. So it's really helpful to have adaptive sitting alongside us, funding our customer funded deals. It's really good news. I'd also just like to say that there are further significant opportunities we've identified where we think we can reduce net working capital through better planning and improving vendor supply terms, which will also help boost cash in the second half of this year. So we're not complacent. We're pleased with the first half. There's considerably more work to be done, and we expect to see further improvement in the second half of this year. Thank you, Harvey. I'll hand back to you.
Great. Thanks, John. Just touching on the market opportunity, because we see these questions come up regularly across both the investor discussions we have, but also on presentations. We're principally a public sector business moving into healthcare from a very strong leadership position in education. The education market is still a very large niche, 65% addressable market, where we're starting to see increasing appetite for Gen 1 energy efficient lighting to be upgraded to Gen 2, which is further increasing the availability of our revenue growth, because our existing 1,200 customers are now starting to come to the end of 5 to 7 year contract terms, where we hadn't previously forecast that being an opportunity. The expansion into higher education is where we're starting to access £1 million plus projects. And for a business of our size, having migrated from £100,000 average order value projects 2 to 3 years ago with single client entities, as you know, we migrated to multi-site projects where we were able to get average order values up to 2 to 300,000. We're now starting to see average order values going up to 500 to £1 million. And we've got a number of £1 million plus projects and some several £1 million projects that we're tendering for. This is typically in the higher education, campus, multi-site, college and university market, which is very, very cash constrained, very low budget allocations for infrastructure upgrades, and which is now very, very interested in the off-balance sheet funding. And we think this is going to be a significant opportunity for growth. We've seen huge improvement in our case study delivery across the NHS and healthcare market. That is now enabling us to use those case studies for tenders, and we're starting to see huge pipeline growth in the private and public healthcare space. And we think that due to our strong case studies over the last 6 months, we're going to really see the NHS and the private healthcare become a strong sector, in particular from the framework and tenders that we're submitting. A number of notable contract wins on the right there. I don't need to go into those, but I do want to just talk about some of the long-term drivers of growth that we see for multi-million pound projects that we're now very focused on. And that is tender driven, compliance being the important factor for finance, with a very unique product in the adaptive solution that's truly off balance sheet, approved by auditors, that we think is a unique product in the market that can unlock huge appetite for energy savings where there is no budget availability and a pressing need to get to net zero. One of the bullet points that's not on this slide is our commercial strategy for solar. The real estate landlord market is our principal targeted market sector. Through channel partners, through agents, and through our own network of partners is where we see the mid to long-term growth. This is both advising on PPA agreements that will be self-funded deals from the client and therefore delivering those projects, but also by providing on and off balance sheet funding for those projects. And we've got huge and growing pipeline in that area. Just touching lightly on the routes to market, we have a very consistent, very predictable direct consultative sales model, in particular for schools, that is growing rapidly. To give you some context on that growth, this time last year, we were forecasting 12 to 13 million of direct sales into the education sector. That now looks like it's more like 16 to 18 million this year. So we're seeing 25 to 30% revenue growth in direct sales, partly through our new regional approach, partly because of our move into higher education, and partly because of the new financing products that are opening up new opportunities. So that is staying on course, but growing organically. Layering on top of that is a fundamental shift, which we've now embedded as part of the core fabric of EENERGY, which is a frameworks and tender platform. That's both technology enabled, it's both framework enabled, but it's also intrinsically part of our development structure. So we're now monetizing huge members of the team that previously did not carry targets. Previously, only the direct sales team were revenue bearing. Now we have another 20% of our overall cost base in the business actually carrying targets as part of bids and tenders. So we've started to gear operationally the profitability of our business, not by expanding new team members, but by having existing developers in the business now starting to be revenue carrying. The strategic partnership route I've touched on, it is extremely important to us that we build out a commercial industrial solar business, both for delivery of projects, but also for operations and maintenance. I would say probably the key differentiation for EENERGY in solar is to position ourselves as a high service quality, high service delivery model, not selling on price, but selling on complexity. So doing complex projects, big, large curved roofs. Solar carport schemes is becoming a very strong niche for us. We're one of only a handful of players in the UK market that has got significant at scale case studies. And you'll start to see some announcements coming through in the coming weeks of some great successes we're having in this particular sector. And it's being strategically positioned as one of the strongest growth, highest margin areas for UK solar to grow, which is off the roofs, off the fields, and into car parks where you've got unmonetized space for both tenants and landlords. For those that are new to the call and new to the investor story, 4 key business models: reduction, driving energy savings through efficient lighting and controls and data analytics, delivering 40 to 45% gross margins. Obviously lower when we're tendering, higher on direct kind of focused projects, but strong margin business, strong growth, high addressable markets, market leading position. We've got a fix on the supply chain. We've got a very efficient and at growth model for delivery, and we're seeing that grow consistently, and it's a real pillar of our whole core proposition. Generation is all around solar, roof, ground, and carport schemes. Lower margin, but larger money margin projects, so larger value projects, and we're typically targeting 500 to £5 million projects. We are moving away from small projects. We're outsourcing those if we get the leads, and we take a small developer fee to our partner companies. And we're very careful about what projects we want to bid on. We don't now bid on projects where there is clearly a race to bottom pricing. We quickly move away from those projects because we don't think that's where our focus should be. Our focus is on complex projects where there's risk solutions required, where there's insured concerns over tenanted buildings, where there is complexity and structural issues, that's where our team is excelling, and that's where we're seeing our kind of margins being sustained at the 30% level. We still do have a strong EV position in the market in the sense of our capabilities and our service offering. We're not pushing it strongly as an individual solution, but we are starting now again to see some significant tenders coming through and some significant multi-site rollouts for either existing customers. And we're quietly confident that this revenue line will start to wake up again. We just haven't been driving it hard like we have been driving LED and solar. But I do feel confident that there will be some pleasant surprises in our revenue forecast in the next 6 to 12 months that's currently not in budget. So this is all upside. And then wrapping everything we do is a complete off-balance sheet, capital-free service wrap that's self-funded to enable clients to deliver both their carbon savings but also their cash energy savings without having to invest any capital. It's a unique proposition. There are very few people that have the capability in the public sector to even offer funding because of the complex nature of compliance, but we're the only people that have a genuine off-balance sheet solution. And we know that for sure because we have completely scraped the market for suppliers, for service providers, and indeed on both client side. We are absolutely confident we're the only off-balance sheet solution available in the market that will be approved by a top 6 audit firm. And we think that's going to unlock 7-figure deals in the future, in particular for the NHS. Many years ago, we invested in the concept of automation for our end-to-end service proposition, enabling the assessment of LED projects to be done outside of a manual process. In the last 12 months, we've reinvested a lot of time and some capital to the extent of taking that to a fully end-to-end product. We've got something truly unique in our effectively our EENERGY app that's going to be significant in the growth capabilities of this business and the gearing and scale and pace at which we can move. Just to give you an example, it typically takes anywhere between 2 to 3 weeks to assess a physical collection of buildings, and then another 1 to 2 weeks to move through to a process of designing and delivering with specific designers and specifiers a solution for that client. We can now fully automate from survey with our app a proposal within 24 hours and be within 1 to 2% accurate on both the energy saving specification and turnkey solution. And we've got evidence that we can go from survey to contract close in less than 30 days, where previously we were thinking our estimate best case was 90 to 120 days. So we've saved our end-to-end process a 70% time saving, but more importantly, we've reduced the number of people working on projects and we've doubled the amount of projects we're working on. So this has the capacity internally to create mass scale and create mass efficiencies in our business. And we will expect to move this over to the other technologies that we work on in metering and also in solar in the coming months. And there is a possibility that we will explore a licensing model for both other contractors to use and monetize our offering here, but that's not currently in FY25's budget. We may think about a 2026 business plan to extend out a digital platform for scaling this app. So to summarize, in the last 6 months, I think what has been demonstrated that our strategy is working. We've grown revenue, we've talked about the increase in pipeline, and we've talked about the increase in our margin. We're winning bigger contracts. We're moving into multi-site contracts in NHS. We're no longer just an education schools focused business. We've secured an institutionalized funder, and despite some of the challenges we've had, this funder is 100% committed, and the testimony of being able to raise a 100 million partnership fund demonstrates the belief in our business model. We've deployed that cash and we've started generating positive cash flows. We've launched an O&M business, which is from a standing start already generating recurring revenues of nearly 90,000 a year. We've appointed been appointed rather to 5 frameworks. These are difficult frameworks to get on. They are a very important right to play within certain sectors, and it's giving us strength in our reliability and de-risking direct sales and giving us scale. Partly our boosting of ESG credentials has enabled us to score higher in these submissions. So we've worked hard on our ESG credentials, we've worked hard on our compliance, and we've worked hard on the platform investment to get us to that point. We've proven the scale of EBITDA. We've now shown that as we look over H2 of last year and H1 of this year, this business is starting to scale and deliver profitability. And this period now demonstrates cash generation. So we've got the capability of driving 35 to 40 million revenues without any increase in our cost. We're demonstrating that. H1, we've demonstrated nearly 70% growth year on year. We're now expecting to do the same revenue in H2 of this year as we did last year. So there is, of course, upside, but we want to manage the downside, and we want to manage expectations. So we are very confident that we have got the capability to deliver H2 in the same way we delivered it last year, albeit at greater profitability and on greater cash generation terms. Our pipeline year to date, strongest as ever generation, 83 million of pipeline generation year to date. This time last year was probably more like 20 to 30. So a 300 to 400% increase in pipeline generation in period. 38 million of that is under assessment, but more importantly, 15 million of that has been signed commercially at heads of terms for H2 delivery. And I'll talk you through what that means on a weighted forecast basis in a minute. So when we look at this pipeline, what we've got here is 2 graphs. We've got an LED graph at the top and a solar graph at the bottom. We've got 2.5 million of contracted, that's in-flight projects, where we've got an expectation of delivering 10 million in the second half. We've got a total pipeline of 29.5 million. 9 of that 18 is weighted, and we've got a target of 10. So we've got plenty of coverage where we feel confident of delivering a 10 million revenue for H2, which would give us, in a broad sense, a 19 million LED business for the year, which is up 30% year on year. Significant growth year on year for the LED business. On solar, we've got in-flight projects that are being installed right now of 1.7 million. We've got a total 64 million, of which that 1.7 sits within, and a weighted forecast of 12.4 of revenue that we expect to deliver from that pipeline. But 15 million of that has signed heads of terms, and we've got a target of 8. So we've got an 18 million number that we're expecting to deliver on market expectations that gets us to 28 million for the year. 8 of that is from solar, 10 of that is from LED. This demonstrates the kind of coverage we now have. This time last year, the total pipeline was our forecast. We did not have any coverage. Now we have coverage. So we do expect, obviously, there to be some slippage. That's why we've got a weighted forecast. But the great news is that will all slip into Q1 26. So we're now starting to work on H1 26 from a solar perspective. And in fact, all of our focus now for solar is about FY26, and it's about delivery of the weighted forecast. So these are really important stats, and I think you'll agree that this demonstrates mass improvement and also much more visibility for investors about what we're doing and internally how we manage risk in the business. So revenue, EBITDA, and cash flow are now at an inflection point. John and his team have done an amazing job. We've got a really close-knit, strong management team. We've got much more controls in the business, organically focused. We've got no more distractions around historic legacy issues that have come out of a very busy M&A period. We're focused on cash, as you can see from John's philosophy. It's all about cash and profitability on margins. The cash coming through is starting to be stronger quarter on quarter. We've got a big focus on H2 around the improvements we can make on increasing both margin and EBITDA. And that's really the theme of our management strategy. So as we look for the outlook, clean and stable balance sheet, strongest pipeline in our history, board confident that we're going to maintain revenue growth for H2. We're maintaining our market expectations. We feel confident we've got coverage, we've got solar growth coming through and accelerating, and we've got unique products, technology, and financing abilities. So I hope you can see the progress we've made since our last update, and indeed over H1. Obviously, we look forward to updating you as we go through the next trading period. Thank you.
Perfect. Harvey, John, if I may just jump back in there, and thank you very much indeed for your presentation this morning. Ladies and gentlemen, please do continue to submit your questions just by using the Q&A tab that's situated on the right-hand corner of your screen. But just while the team take a few moments to review those questions that have been submitted already, just like to remind you that a recording of this presentation, along with a copy of the slides and the published Q&A, can all be accessed via your investor dashboard. Guys, we have received a number of questions throughout your presentation this morning, and thank you to all of those on the call for taking the time to submit their questions. But Katie, at this point, if I may hand over to you just to chair the Q&A with the team, and if I pick up from you at the end, that'd be great. Thank you.
Thank you very much, Jake. Thanks, Harvey, John. So we've got a few questions come in. So we'll start with the pre-submitted question, which was about the share price and why do you feel like it doesn't respond to good news and keep up the momentum?
Yeah, sure. Okay. So look, it is one of the challenges of being a small cap public company. We have sporadic and strange liquidity issues within our stock. We don't have a strong institutionally led share cap table. We clearly have either a single seller or a group of sellers that are willing to sell at a 4p price. It's incredibly frustrating. Both myself, management, and the board are all shareholders in this business. We share the same frustrations. So the question is, what are we doing about it? Trying to build confidence in our shareholder base to turn sellers into sort of holders. That's the first and most important thing to do. Create belief that this is an undervalued business, which we all internally believe it is. Compared to our peer group, we feel we should be trading at an 8-9p share price. There's nothing much I can do about the seller other than try and convince the sellers that holding is a better strategy than selling. The second thing we can do is we can put our brokers under immense amount of pressure to come up with a strategy to provide new investor appetite, either at the institutional, family office, or high net worth individual level, that can either take block sale opportunities from sellers or come into the secondary market and start effectively becoming a holder, not a seller. So we're doing that. We've got meetings today with Canaccord. Frankly, they're going to be under a lot of pressure. I'm going to be demanding a much greater level of focus and attention. And I hope to see a different outcome. We'll also be deploying other investment channel ideas through investor presentations, roadshows. Now that we've got the past behind us, my focus will be on trying to sort the issue out of our capital structure. I hope that answers the question.
Thank you, Harvey. Yes, we had another question about addressing the stock overhang, which I think your answer also addressed. Moving on, there is a question about the Redactive partnership and how close EENERGY is to the first project win.
Look, very close. We've signed heads of terms with several £1 million plus deals. These are clients of Redactives in the US that are doing UK rollouts. With solar, there is a lot of complexity. We've got engagement with Redactive, we've got engagement with the client. I believe our solutions are first class. There are always third-party dependencies within the solar business model, which are grid connections, building condition reports, structural surveys, and often landlord-tenant divide around who's approving and who's agreeing to take the risk. These are all things that we have to navigate, but we're at an advanced stage. I am confident that we will deliver our first project in Q3. As I say, deliver, sign, and then hopefully deliver by the end of the year. But we have a number of very exciting projects working, and we continue to see new ones each week.
Thank you, Harvey. There's a question around the split in H1 revenue of 10.1 million, and saying they were told that it was 7 million booked for Q1, which they think means Q2 was 3.1 million. Can you give any more kind of detail and color around that, please?
We did have quite a bit of slippage. So we had locked in 7 million of contracted that we were expecting to deliver all in Q1. Some of that slipped into Q2. One of the frustrations about our business is it's a projects business. Things do happen, things do slip. We've also got a lot of stuff that's already slipped into Q3 already. So it's a game of two halves in many sense. We contract, we win, and then often we can't recognise because a project gets delayed. We've got a lot of overhang coming into the July to October period. That's great because it means we're underpinning H2 already. So I think it's a slightly skewed picture. I don't think it's a slowing. It's definitely not a slowing down picture of, oh, we did 7 in Q1 and we only did 3 in Q2. No, it's just a shift of when the revenue got recognised. And I think overall, actually, Q2 was a much stronger performance than Q1. So hopefully that answers the question.
Thanks, Harvey. And actually, another question slightly in line with that is, to meet 2025 numbers, 18 million needs to be earned in H2. How confident are you that this will be achieved?
Look, I think I've tried to explain as best I can, and I've got into probably a lot more detail than would be normally expected on a presentation like this. But we did 19 plus million H2 last year. We need to do 18 million this year. Of course, we're targeting more, but we are expecting to do 18. 10 from lighting, 8 from solar is our current split. It may end up being 9 and 9. Again, it all depends upon some of the larger solar projects, how quickly we can get them signed and part recognised and then part installed. I am confident. I think we've got a very predictable lighting business now, which has a shorter sales cycle. The solar business does have a longer tail. That's why the weighting is so important. We've got 15 million of heads of terms signed where clients have engaged contractually. Those deals are happening subject to 2 third-party dependency. One is inability to get a grid connection. We've never had a client being refused a grid connection. It's just a timing issue. Okay. Structural surveys are done in advance, so we're not concerned about that. So generally, it's a timing issue. It's a phasing issue. We've got to deliver 8 million of solar. We've got a 15 million heads of terms pipeline of signed contracts. So it's a case of making sure we can accelerate at the front half of the period, that we can deliver those projects quicker and enable them faster so that we've got enough time to get them completed. I've got total confidence in my delivery teams. And in fact, the operational teams have never been as efficient as they are now. And our 2 operations directors that run lighting and solar work very closely with John on a procurement and on a margin predictability perspective. But on a delivery perspective, they are first class and are on plan and above budget.
Thank you, Harvey. You mentioned about the kind of solar £50 million booked. There was a question around how much of this would be recorded in H2 2025.
Yeah, so that's a sort of follow on. We think circa 8 to 9 of that's going to be actually recognised. And that's simply a factor into some of that 15 million will start but not finish in time. Some will start and finish. Some will start and finish in Jan, Feb, March. So that's why we're very focused on the phasing and the weighting. And we spend every week reviewing that heads of term schedule, myself, John, and our operations team. We think we've got enough coverage.
Thanks, Harvey. Again, slightly following on from what you just said about the weighting, there was a question about, could you explain further the calculations or assumptions to arrive at your weighted forecasts?
Okay. We have a weighting per phase of our development customer life cycle. So in simple terms, we don't weight anything until it's gone through to assessment. So the upfront forecast pipeline doesn't count in the forecast I deliver to investors or to the board. In other words, leads, opportunities don't count in my numbers until we've gone through a series of qualifications and on-site assessment. That's phase 1. After we've done a survey or an assessment, we've got a predictable phasing, forecast and qualification status that we've seen over the last 9 or 10 years that gives us confidence how we can weight that. That's based on clients' appetite for starting a project, clients' ability to have budget, clients' appetite to use funding, and whether it is or isn't a competitive process. Once we've delivered the proposal, it's then an investment grade proposal, which means that it's gone through the full phasing of qualification internally from our side and from the client side. It's been delivered to the decision makers, and we now have a weighting according to time. And then based on time and based on engagement and based on progress, it gets weighted accordingly. So we use Salesforce for the complete end-to-end customer lifecycle. Our new chief commercial officer spent a lot of time over the last 3 months re-cleansing data, re-cleansing stages, re-cleansing all of the project statuses. So I would say we're probably the most sophisticated business I've ever seen of a business of this size in the way it manages pipeline and the accuracy of its forecasting.
Thank you, Harvey. Moving on to the NatWest loan facility, someone has asked, please can you confirm how much of the NatWest loan was bought out by the new facility?
John, do you want to answer that one?
Yes. So the total is about £6.3 million, which has been drawn down from NatWest and Redactive purchased it all.
Thank you, John. Another question is, please can you provide some examples of aspects of the project where the new focus on cash flow has changed the structure of your bid, or where you have possibly declined to bid?
So there are many opportunities we see coming through the business which have an expectation on a price per kilowatt to build a project, which we rule out straight away because we're so close to build costs in the solar sector, for example, that where we see an aspiration by a client to achieve a certain level, we'll just walk away straight away. We're not interested in competing in an open environment with 3 or 4 other people if the margins are going to be sub our target. So that's one example. The other example is where we have a very large project with a right to play and we think a right to win, we will of course take a view as to whether or not we will adjust our margins. Now, because the money margins are so significant on a multi-million-pound solar deal, and if we think we've got a right to win and we think the drivers of the customer in the right way, we will always consider doing a lower margin deal if the terms are right, if the right to win is right. If it's a several £1 million project, the expectation is it won't be as high margin as a sort of a single source project. So that's been an example where we will be flexible. And then I think it's a case of being confident in the route to market that we've got and the client engagement.
Thank you, Harvey. There's been a question around how contracts work and if you can explain a little more around them. For example, if you announce a £1 million contract and income is generated over 10 years, do you book 100k revenue a year?
One for you, John.
So what we would do is we would recognise 30% initially on the signing of that contract. We wouldn't because just to be clear, if it's a £10 million contract, if it was operational and maintenance revenue, we'd recognise it over the life of the contract. But none of our projects last 10 years in terms of installation. So the installation typically for lighting lasts up to a month or 2. So we would recognise 30% on signing, and then the balance pro rata between the start on site, the SOS, and the finish on site, the FOS. We recognise a revenue on a pro rata basis after the initial 30%. So that's how we do all the installation revenue, which makes life really, really straightforward on AD. On solar, it's slightly more involved, typically because the project installation period is longer. So if you had a project that was being installed over, say, 4 months, again, we'd take 30% on signing because we will have incurred substantial costs to get to that point to be able to give the customer an investment grade proposal on which both them and us are willing to sign off on. And then again, over the life of the project, between when we start on site and finish on site, we would then recognise the balance of the revenue. Those dates are important because it's a date that's been agreed with the customer. It's been agreed with our operations team, It's been agreed with all the vendors. So if anybody supplying components and hardware needs to know when do they got to get the product on site. And it's been agreed with the contractors. And most of our customers are quite time sensitive and they need installations in certain key windows. So those dates are really important. And the other nice thing from my side is that they don't change that often. Occasionally they do, mainly in solar, but the LED ones don't tend to change very much, which also then means that we are recognizing the revenue on a fair, consistent, sensible basis over time, with no management override of controls. It's coming through exactly as the contract is fulfilled. So it's on a pro rata basis after the 30%. If we were doing operational maintenance revenue, and that's let's just say that contract was in place for 10 years, we would recognize that revenue over the course of the contract. So it's important to say that. So that's a key differentiator. And similarly, if it was a funded deal, so the deals I've just described are sort of CapEx deals and funded deals for the installation. If it's a funded deal where there's a third party providing funding to the customer, we recognize the interest on that contract over the life of the contract, and we recognize the interest expense in our finance costs for the ongoing business below EBITDA. So that's how we would do it. So in summary, for installation revenue, it's over the installation period of the contract. O&M, operational maintenance revenue, is over the life of the contract, as is the interest income that comes in associated with a funded model for either LED or solar. Hopefully that answers your question.
Thank you very much, John. There's a question around EBITDA, and someone notes it appears quite low. What percentage do you build into tenders? Can this be increased without losing business?
Okay, I have to pick them up. So, yeah. So as Harvey said, we would look at the competitive landscape and try and price it at a price which we would hopefully be confident of winning it. And that is normally based at a gross margin level, not at an EBITDA level. The EBITDA level for the operating business is after all the operational costs. So what we try to ensure is that obviously if we're pricing it at a sensible gross margin level and it's incremental gross profit, that's adding to our operational EBITDA. So we focus very, very much on the gross margin when we quote for the work, and would price that business accordingly. We price it to win it. So gross margin is the focus. Obviously, from a financial perspective, one of the ways in which we've sought to improve our financials at the bottom line is to reduce and control the cost base that generates that revenue. So we've taken action at 3 levels. One, we've got the right pricing, so we've improved the controls over product, the costing of the product, and therefore the pricing of it and the margin. We've reduced the cost base that's required to deliver that revenue, which is obviously has a big impact as well. And we're controlling all the costs as we go through the project to make sure there's no margin leakage. So gross margin is the focus, which then obviously results in a bottom line EBITDA margin, which for this type of business, from where we are today, the operational business was doing just over 14% EBITDA on revenue. I think as we scale the business up, that number could certainly be north of 20, and potentially could get to sort of circa maybe 25%, depending on the mix of revenue and the size of contracts. It is easier to manage 10 larger contracts than 100 smaller ones, just because there are less contact points. So the revenue mix also has an impact on the cost base.
I think just to add to that, I think what we've got to remember is that we are a public company carrying circa 1.5 million of cost. That's an exceptional cost for running it as a public company. So when we think about an alternate exit to a strategic acquirer at some point in the future, they will be looking at the pre-PLC contribution, which is why we're very clear to demonstrate pre-PLC costs. On 28 million, this business, we're expecting to generate over 4.5 million of EBITDA. That is a very healthy EBITDA margin. As John says, we believe we can drive revenues from 28 to 38 without any real significant increase in costs, and that's all going to go to the bottom line and take us past the magic 20-25% EBITDA level. And at that point, I think we start to see a completely different value inflection point in this business.
Thank you both. There's been a question around having a bit more detail on the one-off 400k share-based charge and related detail on the vest price.
Okay, so the share-based payments charge reflects all of the existing share option schemes. Each scheme is valued by a third-party advisor using what's called the Monte Carlo model, and that is a way of effectively valuing the share options at that point in time, at the point of award. And then there's obviously a P&L charge to spread the cost of that award over the life of the share option, based on the probability that those options will vest, which is all contained within the Monte Carlo model, and is audited by the auditors to check that the assumptions are correct. We spread the cost evenly over the life of the option.
Thank you, John. We've still got a handful of questions left, so we'll see if we can get through them in the next 5-10 minutes. So moving on to the next one is, what levels of growth are you forecasting for the short and medium term? Okay,
so for the current year, we're looking at circa 12% growth in revenue to get us up to around 28, which we did just over 25 last year, and then a further 10% growth in revenue for 2026 to take us on to circa 30.6 million, something of that magnitude.
Thank you, John.
I think, just to say that they are the forecasts that our brokers have got in the market. What are we targeting? A lot more. We are targeting much greater growth than that. We're not forecasting it, but we're targeting greater growth than that.
Thank you, Harvey. There is a question about whether Light Science Technology is a competitor.
No, they're not.
Another question is, has inflation affected the materials cost, and are the project estimates adjusted if the project is delayed, or do we take that as an additional cost?
No. So we have sensible contracts with our contractors that give us fixed price quotes for certain periods of time, and we have flexibility with our customers that allow us to go back to those customers and vary the price if they have not accepted the quotation within a reasonable period of time, which is specified in the contract. So we are in a much stronger position now than we used to be regarding inflationary pressures on the vendor base and margin leakage from the customer's perspective, where things are actually costing us more and they refuse to pay for them. So we're in a much better place on both aspects.
Thank you, John. We've touched on Outlook quite a lot, but there's a question of, because of the overhang and project overflows, are we expecting a super strong H1 26 in comparison to H1 25?
So what I would expect is, if we are successful in H2 in the same way we've been successful in H1 of driving pipeline generation, and if we're successful in migrating a blend into commercial industrial for solar and a NHS driven, let's say, split on our public sector strategy, we should see slightly less seasonality, and I'm hoping that we should start to see a more regularized H1, H2. H2 is always significantly stronger because of the summer install periods. That said, I would like to think that next year we could see significant growth in H1. We're not forecasting materially different forecasted growth, but we are targeting very different growth. And I'm hoping that as we get through Q3, we might be able to update the market to such effect.
Thank you, Harvey. And just finally, the last question, how many framework pitches are currently live waiting on final decisions?
Certainly more than a dozen that are material. I only keep my eye on stuff that's over $500,000 in value now, but yeah, increasing week on week. I would say we're seeing a stronger framework growth than expected.
Thank you very much, Harvey. Jake, back to you.
Thanks, guys. That's great. And thank you very much indeed for being so generous of your time then, addressing all of those questions that came in from investors this morning. But Harvey, perhaps before really now, just looking to redirect those on the call to provide you with their feedback, which I know is particularly important to yourself and the company. If I could please just ask you for a few closing comments just to wrap up with, that'd be great.
I think just to summarize, I hope today's presentation has given a transparent look into our business. I think we've taking time to think about your questions in a very considered way. We want to keep the market updated. We're very confident that we've got a strong business, and we hope that investors will start to support that. And if they're thinking of being a seller, they will change their mind now and start to be a holder.
Perfect. Harvey, John, thank you once again for updating investors this morning. Could I please ask investors not to close this session, as you'll now be automatically redirected for the opportunity to provide your feedback in order that the management team can really better understand your views and expectations. This will only take a few moments to complete, but I'm sure will be greatly valued by the company. On behalf of the management team of EENERGY Group PLC, we would like to thank you for attending today's presentation. That now concludes today's session, so good morning to you all.